Hi everyone, welcome to another episode of Fraz's Capital Podcast. Ellianna, thanks for coming back on.
Hey Mike, thanks for having me back. How are you?
I'm good. There's a pretty strong recovery in the last few days of this week, so that's always nice to see.
Yeah, it's been a strong couple days in the market. I want to start off with talking about Google, who released their Q1 earnings yesterday. And they beat on both top and bottom lines, up 12% year over year with 90.2 billion in revenue. I thought the mix around in their operating margin was quite interesting. So it only grew from 32 to 34% since last year, but was quite interesting as cloud grew from 9.2% to 17.8%.
It's a big increase in margin, isn't it?
Absolutely. And especially with majority of their revenue coming from YouTube and search, I think how they're changing things internally is quite interesting, which came out in their earnings this quarter.
Yeah, I think it really calms everyone's jitters because they'd sold off a lot. So from February they dropped 32%. It was a pretty sharp sell-off for most tech stocks. Like 32% is a big sell-off for a company like Google. It doesn't often do that. And obviously that's one of the larger, more stable ones. But there were these question marks around everyone's using ChatGPT for a lot more things. Everyone's using AI. Is that it obviously is a competitive threat to Google, but would that turn up in the numbers? And I think the answer is kind of decisively not yet. And if anything, it seems like their cloud business, which is very heavily AI focused, is actually doing really well.
Right, and they announced a $70 billion buyback. EPS is at $2.18, and it seems like markets responded really positively to those announcements.
Yeah, those buybacks are enormous. I mean, these sell-offs always seem to happen in these periods right before earnings when basically the big tech companies pull back from the market and then bang, like within a week, all the big tech companies report and then you get this massive bid under the market, which is the companies buying their own stock. I thought it was interesting. It's just like the range at Google is just so impressive. I mean, you have Waymo, which is, launching in Washington, already in like Austin, Silicon Valley, California, moving to Miami. By all accounts, they're taking huge market share from Uber, which is a $160 billion company. And then you've got Google, right? Sorry, YouTube. You've got YouTube, which, is the number one streaming platform by hours. And then people are just uploading video all the time, which just adds to their pool of training data as well. So it's a pretty impressive company. It's probably the cheapest of the big tech companies. And I wonder if that's like going to really help settle the nerves here. Because big sell-off, everyone's scared about tariffs. There were signs that, you know, domestic spending was rolling over, travel was rolling over, Las Vegas was emptier than usual, all those kinds of things. But in their earnings call, they actually called out that travel was a contributor to growth this year. Or in this earnings report. So again, kind of like the AI fears, it hasn't actually played out, and you've just got another massive blowout profit result from a big US tech company. And maybe there's more to come, in which case this will be one of those rare, big tech buying opportunities where you had these companies down 30% over a period where they performed really well. And they continue to grind higher and make every active manager that doesn't own them look really silly.
Absolutely. And how do you see these results specifically from Google, who is a very significant player in the market? How do you see like the ripple effects going across the entire sector?
The default. What happened was there was a huge sell-off and a huge liquidation in momentum funds, the quants, the CTAs, the volatility targeters, which manage hundreds of billions, if not trillions of dollars. They all went from like max long to very close to max short. You had institutions and hedge funds degross massively reduce their longs. Like this is like the groundwork for a really strong rally. So usually you'd think that, that's enough. Like the market has taken enough blood. I feel like people talk about Mr. Market, like some friendly guy that gives you discounts. Sometimes I think it's like an Aztec god that demands blood sacrifice. And the more inexperienced and young you are, the more blood it demands. Um, and I feel like a lot of blood's been spilt. That these are big drawdowns. There were a few days where, like, if you panicked on those big down days, markets are basically all up. So there was huge volume going through the market, so huge selling. All that selling is now at a loss, and ultimately that money never stays on the sidelines forever. It will come back in, and that's when you get these long, 6 to 18 month low vol rallies. Now, what could derail it is if things need to deteriorate. So if it's just business as usual, slight slowdown. Maybe business does a bit better, a bit worse than expected, but broadly the same. We've got really good groundwork for a sustained rally. If things to deteriorate, you'd need something bad to happen, which I guess the jury's still out. But like the Google result, it just hasn't happened yet. So yeah, it'll be interesting to see. I mean, we were encouraged. I had an old colleague who used to talk about Australian biotech and small cap stocks as the Aussie Oracle, he called it, because they would lead. It's like if you're in Aussie small caps, you're like at the pointy end of the risk market. You know, it's like if the market's going to sell off, usually that stuff gets smashed in Australia long before like indices sell off, and then lo and behold, the next day there's like a terrible red day. And it was really encouraging to see this week that all those companies just had huge upwards movements. So, you know, we have big positions in Clarity, in a number of biotechs in Australia, notably Clarity Pharmaceuticals, Antas, which does heart valves, and Syntara. And those companies, you know, got hit twice, particularly hard this time, because there was a US biotech sell-off and then Opthea collapse. And there's not that many funds in Australia that own these companies. And there's no doubt that a couple of them were just hosing their positions. And, you know, Clarity basically went from just under $9 all the way down to $1.40. And we know that people were shorting heavily into that, you know, 1 million shares a day kind of short. You know, it's now kind of $2.30. So those shorts are down over 40% in a week. And it was almost like Clarity went up from $1 to $9, basically in a straight line, sucked in all this momentum investors. Then it peaked, everyone who wanted to buy bought. And then it reversed, people started shorting, and then one by one, everybody was like, okay, actually I've made enough money, I'm out. And you could just see the market kind of slowly capitulate all the way down to $1.40. But I think that momentum unwind is over. And it's probably over because their data has been exceptional, both in diagnostics and therapeutics. And, you know, we're just in that opposite situation to where we were at the top, where everybody was really pulled up and everybody loved it. Now everybody's like, seems to be shorting it and is worried about whether it's going to have enough money to go forward, which obviously is very unlikely to be an issue. So I actually think it's encouraging to see those huge moves in those companies. Another one, Antas, you know, that listed at 6, went to 8, and then went from like 8 to like 2 or 3, like almost in basically a week or two, which I happened to be traveling for, which was not very pleasant. But again, nothing had changed. It was just like one person deciding, or one or two firms deciding to close positions. And, you know, on the last trading day, it was up 30% and is already halfway back up to the IPO price. So again, I think that actually continues. And we recorded a podcast with the CEO, Wayne, at Antas, and I think that'll be really interesting for people because I don't think anyone really knows about that company. It's not widely followed, but the opportunity they have, I'm just going to pause while that car goes by, but the opportunity they have is crazy. I mean, they're going for the valve market, like the heart valve market, which is an enormous industry, and their valve seems to be preferred by surgeons that have used it. And those companies, you know, tens of billions, or in the case of Medtronic, 100 billion plus. In the case of Edwards, which is basically their main product, it's a $44 billion company. This is US. And Antares basically went down, I think it had roughly $2 of cash and traded down to below $3. So you're really discounting that entire asset at next to nothing when it could be worth billions or even tens of billions of dollars. So that was interesting.
Right, and what is Antares' outlook right now for the next year?
Well, they've been in over 100 patients. So this isn't an Opthea situation. We know it works. We're speaking to surgeons that have used the device. And basically, if you need a heart valve replacement or an artificial heart valve, the feedback loop is really short because the operation ends and then the patient wakes up and they walk around and either feel a lot better, look a lot better, or don't. Now, there's like 1 year follow-up, which is the key point. And then what the whole sector is really looking at is the 5 and 10 year outlook. But really in those 100 patients, you know, they seem to be doing significantly better. And the two leading competitors, one's clearly better but harder to use, and one's much easier to use. And also easy to use, by that I mean surgically implant. And so that it's not just like, it's like slightly easier, it's like lower complications, it's like a shorter procedure, it's generally preferred. So then their next step is to do a phase 3. So they should hear back from the FDA imminently, and then they'll be able to start enrolling in that trial, and they'll be able to read out results through that as they come in. And the key point is going to be, you know, how well does the heart valve work, which you can actually assess using scans and literally looking at the blood flow. And you can also assess the health of the patients after a year. That'll be the other key milestone. And then there'll obviously be multi-year 5 and 10 year follow-ups, but the device can be approved before then. It doesn't have to wait until the 10-year mark. So they're kind of at that pivotal moment. They probably need a bit more funding, but we're relatively confident they'll get that. I mean, they just did an IPO. They raised 88 million US at the IPO, so they've got a lot of cash. There's no near-term issue. They don't need to like sell into a liquidation or anything like that. But yeah, I think it's a company that will soon very much be on people's radar, but isn't at the moment. So that's why it's quite exciting.
Right, and also you mentioned Clarity Pharmaceuticals. What's their current outlook?
Well, the interesting thing about Clarity is they've got like a year's cash. So they cancelled a couple of programs. They pushed out their runway into next year, and they're basically two business: the diagnostics and therapeutics. Diagnostics has two phase threes and a separate head-to-head trial. Two of those will read out this year. So two of those trials will have results, and there's going to be this very heavy short interest into those trials. So if those trials do well, then there's a good chance that the share price appreciates significantly. It'll still take a while for them, be 2027 at the very earliest. Realistically, like the first full year will be 2028 before those diagnostic revenues come. But there's this urgent need. There's this urgent need to get a better diagnostic. So if you have a diagnostic that catches 40% of metastatic disease, or you've got another one that catches 70 or 80% or more, everybody's going to use the better one. So this idea, like, will people switch? Of course they will. The doctors will want to do it, but also patients will insist on it. It's not like a consumer product where you have like a dominant, where everybody's got iPhones and trying to figure out whether to get like a Huawei or some weird new brand. There's not like that. Some level of inertia, but the reality is, if it's materially better, everybody will switch with time. And it's exactly what they just did when they basically made Telix and Lantheus the enormous successful businesses they are. Everyone used bone scans. There's existing products in the market. Everybody switched. Actually, not everybody. Like, there's still a huge amount of growth in that market, both by number of scans and going further into penetration, going further into like more regional hospitals and medical clinics. So the outlook for those companies is still good, but they've done it before. It's the same people. The same people that switched in the past to a better product will certainly switch again. And then the stakes are extremely high, because if you have metastatic disease, you want to know as soon as possible, because there's still a brief moment where, like, if you can catch those metastases in time, there's a good chance that you'll be cured, or they'll progress to a bigger size, in which case they can be picked up by modern imaging agents, but then obviously much more likely to continue to fail disease. But then also this allows better treatment in the sense of making sure that people don't get treated when they don't need to be, and can be confident that not going through the next line of treatment, which might be extremely radical chemotherapy with a huge amount of, like, the usual nausea, hair loss, like that kind of heavy chemotherapy. If you can avoid that, you will. And at the moment, because the diagnostics aren't particularly good, it's very hard to have comfort that you shouldn't be going through those further lines of treatment. So that's the near term. The near term is those. And then still another key value inflection point will be early next year, when we get the final data out of their treatment. And we went through, I just sent out an email like a few days ago. If you unpack all their treatment data, it's exceptionally good. Like, you've got people that have been treated with everything, including Pluvicto, the existing approved radiotherapeutic, which is doing $1.5 billion US, and is targeting $5 billion in the near future. They've been treated by all of those, and another maybe an investigational radiotherapy that's not Clarity's, and then finally Clarity's, and then they're getting a huge improvement. These are people that everything has failed, and then Clarity's therapeutic was good enough to make a difference. Now, the reason I draw attention to that is there's a worry. Again, it comes down to like it's a competitive market. There's already multiple lines of treatment, and there's multiple candidates trying to find a place in that. The fact that Clarity so far seems to work very well in people that have tried everything else means that, like, in the worst case, you can have a much higher degree of confidence that it will find a role somewhere in that timeline. Now, my view, and many people people in the industry will tell you this, which is where I got that view from, is that basically you want to move like the low side effect treatments further up the treatment pipeline, and if you can avoid, it's hard. You want to try and avoid taking people's prostates out. You want to try and avoid like very radical chemical treatments, whether it's chemotherapy or anti-androgen therapy, or what they call ARPs. You really want the low side effect stuff to move further up in line. And that's when I say Pluvicto is targeting $5 billion, they just got that approved to move up further in the line of treatment.
And so a low side treatment is something with limited side effects compared to something more extreme like chemotherapy?
Yeah, I mean, the side effects for clarity and radiopharmaceuticals is basically it messes with your salivary glands. Some other minor issues, but like that's relatively minor, right? Relative to, being incontinent or impotent or, all your hair falling out and being, very nauseous. So yeah, the side effect, one of the advantages of radiopharmaceuticals is the targeted therapies. It's not like radiotherapy where you're shooting beams through people, right? You basically got the source of radiation going into the cell and then killing the cell from within. Um, and the more targeted you can be, the less side effects there will be. So a lot of people are trying antibodies, which are bigger, but they're not as specific. They're going into like people's bones. They're like causing, which creates another set of side effects. They're not as specific. They go to other parts of the body. Um, that's kind of the reason why some people are skeptical around those. But actually, the data's still to come on those. That's just a view that we've had. Yeah, it all comes down to that side effect, effect role. Because if you want to move up the line of treatment, you need lower side effects. It's not just about treatment.
Absolutely. Right. Well, that all sounds like it can be positive and something to look out for.
Yeah, I mean, I think there's actually been a bit of a vibe shift, really on the back of one interview, like in the last week, with the FDA Commissioner Marty Makary. He's actually written a book called Blind Spots, which we should definitely read to get insight. So maybe by next week we'll have read that book and we'll know what it has to say. But the interview was very reasonable. Like everyone was freaking out, there's a case that this is a very long-term bottom in biotech, starting from the peak in 2021. 4 years is usually enough time for a lot of wood to be chopped, and the Aztec sun god to get his blood, which in this case he certainly did. But there was a vibe shift based on this interview that Marty Makary, the new FDA commissioner, said. And the FDA has gone through this huge upheaval, thousands of job cuts, lots of noise being made about that, some people resigning in protest. But the experience that we've had is we've spoken to a number of companies, and everyone said that they're still speaking to the same people. The administration themselves said they didn't cut any medical staff. It was all IT and like back office and middle office and support related. He also made the case that the headcount, in this interview, the headcount of the FDA had doubled, the last couple of administrations. So really this is just kind of shrinking it back to a normal size. And I think broadly that's kind of what's happened across all Western governments is, the support, whether you look at universities, government, NGOs, like the support staff, people that aren't really frontline workers, has just expanded everywhere. But most importantly, he said he's really focused on getting drugs to market faster. He said he drew out the case particularly in rare diseases. He really wants to see those treatments get to market. So if you have like a very rare disease, you can't really do a placebo-controlled trial because it's so rare, and if you're dealing with such special cases, you can't really get that big, broad, large numbers where all the statistical things kind of wash out and you get a read. You really have to go on case studies. You really have to go on, does this improve relative to what we've seen historically? And those situations, it's extremely hard to get drugs approved and way too expensive to do these big trials, and they take too long and are very hard to recruit for. So he's actually really interested in like speeding that process up. And there's always that line of thinking, there's always that line of thinking that like these placebo, there's people that even argue against placebo trials. I think that you still really do need them because a lot of these drugs have very bad side effects and patients are generally desperate for anything. So you do need some controls. But imagine if you have a terrible disease and you go on a trial and you get given the placebo, or your loved one, your sister, your mother, your brother, your son, your daughter, they get the placebo. You're like, well, just give them the drug. Like this is important. This is life and death here. And particularly in something like a rare disease, you really want to. It's extremely strict at the moment, and there's people that argue like more for patient choice, certainly speed with which these things go through. Like think about the companies that we've talked about, like Clarity and Antas. They have to wait months in between like communications with the FDA. And when things are approved, it can be months before they're allowed to sell it. So when the trial hits its endpoint, that's not the end. There's still months before you get the final approval. What patients dying in those periods, it's really important. And companies running out of money, that substantially increases the amount of funding all these companies need, which does limit. Because we're at the coalface, I think we have a different perspective. See companies raising money for new drugs all the time, and the vast majority we won't support, and we're probably more inclined to support than most. But we won't do it because the economics don't stack up, and it's too expensive, and we don't think they've got enough money, and there's not enough data to give you the confidence to give them the money. But they're struggling to get the data because they can't afford the trials that they need to give you that confidence. So like these things about funding really do translate into how many of these drugs actually get tested in people and turn into, real treatment. I think if people watch the video, they'll have a different view on the Trump administration. I mean, it's hard not to agree with most of what he's saying, including like some of the sins and errors that FDA has made. Probably the biggest one was around the opioid crisis and how that was allowed to get out of hand. Obviously, people have strong opinions on food as well. There's something going on in the United States that is not entirely clear. Um, so yeah,
Right. Moving on to semis, which have reported down. What is your outlook on that?
semiconductors. So they've been selling off for a year. Um, so semiconducting selling off for a year, and the sell-off got pretty severe. You have companies like Micron that went from $160 to $60 roughly, like huge 60% drops. Kind of slow, sudden, like in probably the first part of this financial year, kind of July, August, big sell-off, and then like slowly bleeding out, and then in this recent tech sell-off, a much bigger sell-off. I think enough blood's been spilled here. I really think that like there's a good chance this is a turning point. It could be famous last words, but the reality is that all the AI companies are capacity constrained. OpenAI is capacity constrained at the moment. They need hardware. There's very good read through into things like Nvidia sales and what people's capex plans are. They're still going full steam ahead. So I really think that like it was one of those moments where, almost like in like Clarity, it was like a big momentum trade from the beginning of 2023 to I guess the middle of 2024, and then the momentum unwound. And how far do momentum unwinds go? They go all the way. We've gone pretty far now. And the demand's still there. So I think it's a super interesting space. I think there's like, for people looking for value stocks, there's a lot there that's really fruitful. There's growth stocks. You've got like the market leaders like Nvidia, which are not losing their dominance anytime soon. I guess the one cloud on the horizon is that what I think was extremely foolish policy by the United States to limit the semiconductors that went to China. So by limiting semiconductor sales to China, they've just guaranteed there'll be Chinese competition in every part of the semiconductor chain. Otherwise, that capital and revenue and profit would have gone to US and European companies. Um, and so, and ultimately, the Chinese AI companies have done as well as the American ones anyway. You had that DeepSeek thing where on a fraction of the budget, they had a leading model. So I think it's really interesting. We've invested back in the space, mostly in the last week. And I really think it's a good opportunity to, try and make some money and get a really good entry point into like a long-term winner and long-term winning sector.
Great. So positive long-term outlook for semiconductors, despite
Positive
the
long-term
last.
outlook. And again, yeah, and again, think of the context. We've got this context where everybody's like completely degrossed. All the algorithms have flipped to short. Like that's the context we're in. Like if anything, you'd always be inclined to be buying in these situations. You definitely don't want to be selling into one of these things. And we're lucky and unlucky because like 60% of what we do is like US growth tech. Our risk models got us out. We're happily in cash. We're probably 30 to 50% cash throughout this sell-off. I guess we got hit very hard nonetheless. That 40% that we had in biotech, when that Optia trial failure came in, everything we owned dropped 50 or 60%. So we still lost or drew down a huge amount there. Now, encouraging this week, we've already made a good part of that back. And there was nothing fundamental that changed in any of those companies. In fact, the point that I was really trying to make with that clarity note that I sent out was that actually everything's progressing, ahead of what we would have liked to see on both the therapeutic and the diagnostic side, and the fact that like there was this huge short interest created this, big dislocation, and it was a really interesting point, a really interesting moment and point in the cycle to invest, which is why we bought back our shares. And did those interviews and like pushed out a note and tried to explain what we're doing. And we'll do the same thing with Antas as well. I think we really need to explain why we're invested in that. Post the interview we recorded with the CEO, so you can hear it from him. And then also just give some background on what we think is like a really interesting opportunity and something that a lot more people should be aware of. And, as these companies recover, so will we. The fact that we had so much cash meant that we were able to buy more in both of those companies at what already looks like pretty good prices, certainly well below where they're trading now. And then we have all this cash that we can now deploy in growth opportunities in the US.
Absolutely. Well, sounds positive, and it sounds like there'll be more interesting things to come, especially in the tech space and in semiconductors.
Yeah, absolutely. Why don't we wrap up there, Ellianna?
Sounds good. Thank you so much for having me again.
Thanks so much for listening in. I'm Michael Frazis, and if you want to know more about us, you can go to www.fraziscapitalpartners.com, and please like and subscribe this video if you enjoyed it. Thanks so much.